Carnival Cruises, ticker symbol CCL, is currently trading at $19 a share. It has been on an absolute tear this last month, up almost 23%. If we look at the 5-year chart, before the pandemic crash, this stock was trading at around $50 a share. It dropped almost 80%. Can it get back to those previous highs? That's the answer we're going to find out today. What we're going to be doing is looking at the company stock, then taking it to my automated stock valuation spreadsheet, looking at the company's financials and seeing if it is a buy or a sell using the discounted free cash flow model, the comparable company model, and the Ben Graham formula for intrinsic value. So yes, as I said, this stock is currently trading at $19 a share, had a big drop off in the pandemic crash and has been trading sort of up and down, even lows of $8 a share, a great buying opportunity there, $6 in fact. It was $14 a share when I last reviewed this stock, and now it's currently trading at 19. So let's get straight into it. If I go to my sheet here and type in the ticker, which is CCL, what this will do is it will load all the latest company financial data, and we can have a little look and see if it is a buy or a sell. So as I said, price $19 a share, market cap of 24 billion, PE of 29.16, which means it is probably, yes, slightly lower than the market average, which is 29.77. Earnings per share of 65 cents and a beta of 2.7, meaning it is a lot more volatile than the market. Analysts are saying it is a buy with a target price of $22.18 a share. Let's have a little look at the revenue here. Revenue is up from 2023 and 2022, 21.84 billion. So that's actually taking it back to revenue levels that were in 2019. And as I keep on going about, that stock was trading at $50 a share at that point. So that's excellent. Not the highs of revenues back in 2010 to 2013, but back to the revenue levels of 2019. Profit, are they a profitable company? Yes, they are, and it's trending in the right direction. They were down minus 10 billion in 2020 and have slowly built that back up to be now profitable in the trailing 12 months. That is excellent, excellent news for Carnival Cruises. Free cash flow, similar story again, 1.6 billion in free cash flow. Yes, they are down. The 5-year kicker is down due to the fact it was higher, but they were down 10 billion, minus 7, minus 6, 1 billion in the trailing 12 months, 1.59. What they're doing with the shares, we can see it's all over the place here. These have been some pretty weird years for Carnival. They did a big share issuance in 2022, but you can see historically they do buy back their shares sort of pre-2020 crashes. So not a massive deal here, but we're more interested in the revenue and profit of the company. Assets versus liabilities, yep, big shoot up as what we can expect here, but the liabilities are decreasing, which is good to see. So let's have a look at the trailing 12-month discounted free cash flow model. What this is a way of valuing companies based on their future free cash flows, and we will see if it's a buy or a sell. So let's just put these numbers in as the averages, although this is all over the place. I have no idea what this is going to give us. It is going to give us a minus $8,000 stock. Now that is obviously not correct because the numbers are all over the place here. So net income margins, we're assuming that this is probably their most recent year of 4%. Revenue growth rate, let's see what analysts are saying in terms of revenue. If we look at the estimates are 25 and 26 billion. Okay, so a little more bullish on that. Oh, actually, let's have a look at what the 5-year is. We can see down here at the bottom. Next 5 years, 271%. We'll go with our 11% estimates currently. Net income to free cash flow. In fact, if we have a look, sort of net income was around about a billion over those years. So it looks about, we'll say 100%, which is a bit lower than that value there. This could give us a very different value, $13 a share. If we look at the trailing 12 months, which is $176, that brings us to a $24 stock. So discounted free cash flow does say it's a buy. If we can have sort of increased revenues to that 26 billion, this could be up to a $33 stock. But yeah, these net income margins, revenue versus net income, if we sort of have a look at these previous numbers, sort of historically we're about 20, and the net income somewhere in the 2 billion range there. So that would put us, yeah, I think these would be a little bit higher. I mean, let's go 10%. That's an $80 stock. So yeah, discount free cash flow says it is a buy at the minute, a slight buy, but obviously we're expecting this to improve. So this discount free cash flow, I'd say, probably puts it anywhere between a $30 and a $60 stock. Let's have a look at the Ben Graham formula for intrinsic value. I think this will like it actually because of what we've just seen in terms of a 5-year annual growth rate. But this is the formula created by the godfather or grandfather of value investing, Ben Graham. And as we saw, analysts are expecting massive growth, 270% per annum. Let's see what this gives us. Yeah, $200 stock. $180 stock. So that is very high at the minute. Let's just bring these numbers a little bit more closer down. 100% revenue growth, 100% growth rate over these next 5 years. That puts it at a $70 stock. So Ben Graham, based on what analysts are saying, he would buy the stock. And finally, let's have a look at the comparable company model. This is a way of valuing companies, looking at similar companies in similar industries. So the two that I think are pretty good are Norwegian, which is NCHL, and Royal Caribbean Cruises, or CL. And this will load all the latest company financial data. So if you're interested, please check out my Patreon if you're interested in this automated sheet. And you can do the stock analysis yourselves, or give me a comment down below if you're interested in any stocks. The Walmart video is out. I know people were requesting that. So let's have a look at this here. Revenue, all over the place. But in terms of revenue growth rate, Carnival is in the middle with positive revenue growth rate. Now, yes, 5 years probably isn't the best number to look at due to the pandemic, but let's continue. EBITDA, 5.3 billion, higher than the other two. Profit margins in the middle of the pack, 4%. Price to sales, price to book. What we want here is these lower numbers, and that is good. PEG, closer to 1 is better, but Royal Caribbean and Norwegian are lower. EV to EBITDA, EB to revenue and PE. Looking at these metrics, you can see actually it is $21 a share or 27 on sort of the high side. So overall, it is a buy according to the comparable company model, which is good to see. If we compare, sorry, what were the tickers there? The tickers were NCHL. Oh, actually, they're here. Compare to Norwegian, NCHL. Nope, what was it? Sorry. NCLH, my mistake. NCLH, Norwegian, and RCL, which is Royal Caribbean. We sort of compare these stocks. This is the last 5 years. You can see that Royal Caribbean has had the sort of greatest increase in that time. Whereas Carnival and Norwegian have been neck and neck. So pretty interesting to see comparing these stocks, but I would say the cruise liners are still a buy in my eyes, and the models do say it is a buy as well. Right, guys, thanks for watching. Please give a like on the video. Check out my Patreon if you're interested, and I'll catch you guys next time.